Okay, as we've seen over time, stocks can give us a pretty good return, maybe a great return, especially compared to inflation, especially over time, and especially as you use compounding and continue to add and continue to buy and let that money grow and compound over many years. There's actually Albert Einstein who said that compounding was the greatest discovery or the greatest phenomenon in the universe, which is interesting. He's the E equals MC squared guy, of course, and yet he recognized the benefits and the power of compounding. But stocks can go down too, and that's the risky part about it. So we're going to take a look here. Well, what's the worst case, a worst case scenario? And at least what history tells us is the worst case scenario was the Great Depression, right? Many, many years ago, and we actually have things in place now from governments and ways they get involved with monetary policy, adjusting interest rates up and down and things to try to prevent another Great Depression. But let's say that's the worst case scenario and it happened again. How could we survive that? Can we survive that? And what actually happened back in the past? So worst case scenario was the Great Depression and this big stock market crash. You might have heard of the stock market crash, and we're going to look at that. Otherwise known as Black Monday and Black Tuesday, and they weren't black because the numbers went up. They should have been maybe called Red Monday and Red Tuesday because the numbers went down, way down. The stock market crash went way down, worst of all time, and it was bad, really bad. How bad was it? Well, on Monday, the stocks went down unexpectedly, down 12.8%, almost 13% in one day. The entire market, one day, boom, down 13%. The next day, down 11.7%. 2 days in a row, down 11.7%, and then continued. So within 2 days, all of a sudden, 24% of returns of investments were gone. Think of that. A quarter of everybody's stock market portfolio gone, zero, well not zero, but gone 25% in 2 days, and how long that might take to make up for it. And we're going to do some interesting analysis here. I'm going to do a demonstration where you can kind of see, well, what was it like and how did the returns bounce back and how did people survive these worst case scenarios, and they actually did quite well. So we'll look at a couple of time periods of the Great Depression, 1929 to 1939, and 29 to 39 roughly, which was the beginning of World War II. Another big seismic traumatic thing in the world, right? World War II. And we'll see, well, what happened between, like, if I invested right, at the beginning of the Great Depression, maybe earlier in the year, 1929, through the Great Depression, how did I do? And how about 1929 to 1945, 46, as far as World War II? And if that's the worst time, how did that end up looking for folks? So let's go ahead and take a look at that, and I'm going to go back to MoneyChimp as a nice little compound interest thing to really help us do that, because they can look back at historical market returns and you can do some what-if scenarios yourself as well. Okay, I'm back here at MoneyChimp.com. This is /features market, dash CAGR. If you just search MoneyChimp compound annual growth rate, or CAGR, CAGR, you'll find it too. Got the link there in the course as well. And you're looking for overall stock market returns. They have a CAGR where it's looking at future values, but we want to look at stock market returns historically is what we're going to look at. And we're going to do some date ranges and things, and look at these worst case scenarios during the Great Depression and World War II. And CAGR, it basically stands for compound annual growth rate. So it's a different number than an average rate. You hear in averages, we looked at the first number was kind of average returns, things that in that portfolio number, we're looking at that 10% average, but actually CAGR looks at things going up and down, and so it's more compounded, and it gives you a little bit better actually number, but a smaller number. You're going to get a smaller return number if you do it from a compound annual growth rate, if you get real kind of geeky about it, I guess. But we don't have to worry about geeky things. We just want to look at returns over the years. And you can see on the left-hand side here, how they have the returns for every year. So if you're wondering, like, well, how was 2009? I heard that was a big bounce back from the crash with where the stock market went down 37% and bounced back up 27% during the Great Recession. A big dramatic time for us. But let's go in more recent history. But we're going to go back and we're going to look at the Great Depression, because we want to see. I want to know the risk here. I want to know what's the worst case scenario. So we'll look at the beginning here. I'm typing just the dates. Here's January 1st, 1929. So the beginning, the market crash happened in October. So there's a little bit of gains early there, but really that big crash wiped them all out. And we're going to go to 1939, the end of 1939. Towards the end of 39, of course, is when the World War II began. So this is really kind of covering that whole Depression decade. So I put in the dates. I'm going to include dividends, like we're reinvesting in dividends, and we're going to see what our return is, and we'll walk through this here real quick. So I hit calculate after I put my dates in, And we'll adjust for inflation in a second. I'll demonstrate that. But first, you can see the average return, even during the Great Depression, was 3.86. Now that's the average. That's not compounded, so a compounded number will be less. And that's where that annualized CAGR is, a negative return, because the stocks go up, but then they go down dramatically. It takes a little more to get, recapture those gains. So that compound annual number is a more conservative number. And you can see that's a negative 1.1%. All right. So even in the Great Compression, I'm not losing 30% every year. I lost 1%, but over a long period of time, over 10 years. Also, the standard deviation is a measure of risk. The bigger the number, the more volatile risk is. And 31% is huge risk. Lots of big swings during the Great Depression. So later in the course, we'll have some things around standard deviation and beta as far as measuring risk. And you'll learn all about that. It'll be real easy. But understand, this just showing this big number means that's really, really risky. And $1, if you invested $1 US, it would have grown to 89 cents based on a CAGR. Not grown at all. It means you would have lost money. Your investment would be worth 89 cents. And you can do the math if you had 10,000 or 100,000, how much less you'd have. But it's not the complete devastation that you might think of during the Great Depression, but it was for a long period of time. That's why holding stocks can be a more long-term game. Now, if we adjust for inflation, because something unusual happened, because think about the Great Depression, where prices, which is inflation means prices are rising in goods and services, were prices rising? Was it more expensive to buy something? And actually no, because think about it, all these people are out of work, the stock market's been crashing, so if we adjust for inflation, let's see what happens here, and we just calculate, we actually get a better return in comparison adjusting for inflation because prices went down, or deflation. So actually, even though my return was negative, when we saw it without inflation, now our return is actually a little bit positive. And our dollar, in effect, comparing inflation, actually grew a little bit because of the pricing pressure of this very devastating time. And you can see that here. Now let's play this out further. Let's say, well, we're a long-term investor. We invested at the great stock market crash, which we're not. This is just truly for academic, so you can see worst case scenario because it's so much better now, but we want to look back at the past as well. And let's say we go up to 1946, right? Right past the end of World War II. We took out the inflation measure. We're adjusting for our dividends. And what happens? We started in 1929 and we went to 1946. What was our return over that time period? You can see it's pretty low, right? It's still, well, 6.49, that's not so bad average, but our CAGR, our adjusted returns 2.77, not the end of the world, but not negative either. Remember, this is the Great Depression and World War II, and looking over the stock market over a period of time. Still high standard deviation, but our dollar grew as well. So even during like a worse period, and I'll show a better period here so we can see, and if we adjust for inflation, actually something unique happens here, or it should, where it went down, our overall annualized return went down, and our actual dollar grew less because we had prices start to come back as there was a recovery, right? So you can see even during these worst periods of time, over 2 decades, almost 2 decades of the Great Depression and World War II, in effect, my purchasing power and my return grew over that time. And you can have fun with this and play with it during different time periods. I mean, if we were to have fun and look at, let's say, 1990 to the year 2000. Well, let's say 1998. You'll see some crazy numbers because that was during the time of the dot-com boom, where the technology stocks took off because of the internet. There's new technology. You can see 18%, and our dollar grew, just dramatically. So you can see how you can have that, and then how the bubble can burst as well. So really the thing to take away from all of this is understand that your investments can grow over time. But there might be some ups and downs with it. But even worst case scenario, at least my feeling on it is you're going to be okay in the stock market, but it's got to be over long periods of time. You can't sell right when the stock market crashed over 2 days and went down 30%. You need to kind of stay with it and either continue to invest. And that's the other secret sauce on this too, is when we saw that Money Chimp thing looking at compound interest, this is not calculating in if I kept buying on a regular basis, because then as I'm buying low, it's actually going to grow even more over time. And if we look at this last chart here of the stock market history returns by decade, you can kind of see how the decades played out This is the average number, but you can see some of these big numbers and some of these small numbers as well. All right, so this is great. So the good news is, yes, you can make money in the stock market. Yes, it's risky, but if you do it over time and if you continually to invest, you're going to be in pretty good shape. And that's been certainly a secret of mine, not really a secret, it's pretty well known among investors, that continually investing, automating your investments, and continuing to educate yourself in what we're going to do in the rest of the course and making better choices in our stocks, our stock mutual funds, and exchange traded funds is going to really help us and help us to be successful over the long term.